Last year's market looked flat, but some investors made 130% while others lost 20%. What did they know that you didn't? Because the real story isn't market performance, it's sector rotation, valuation gaps, and hidden opportunities most people miss.
Welcome to The Explainer. The financial year 2026 just closed its books, and wow, what a year it was. We had some seriously big winners, a few surprising losers, and honestly, a ton of opportunity brewing under the surface. So today, we're going to craft your personal investment playbook for the year ahead. We'll take all that data from last year and turn it into this year's potential wins.
All right, let's get right into it. First, we're going to rewind and understand the very unusual story of last year. Then we'll zoom in and see who really won and who lost out. After that, we're going on a hunt for where the real value is hiding in the market right now. Next up, I'm going to share a really powerful strategy for building wealth that you won't want to miss. And to wrap it all up, we'll put it all together in a simple action plan for you. So, first things first, let's set the stage. Financial year 2026 was, well, it was a weird one for investors. If you just glanced at the headlines, you might think not much happened. But trust me, underneath that calm surface, the currents were pulling in completely opposite directions. And here you have it, the headline story of the year. It's a classic tale of two completely different markets. On one side, you have the Nifty, the big stock market index, which basically went nowhere, ending the year a little bit in the red. But on the other side, while stocks were napping, precious metals were having the party of a lifetime. I mean, blockbuster returns doesn't even begin to cover it. Now, just look at this. This really shows you how huge that difference was. Silver soared an incredible 130%. I mean, it more than doubled. Gold also had a fantastic run, up a solid 60%. And, good old reliable debt instruments did exactly what they're supposed to do, giving us a nice, stable 8%. This right here is the perfect poster child for why diversification matters so much. Okay, so that's the big picture, but it gets even more interesting when you dig a little deeper, because even inside that flat stock market, there was an absolute war going on between different sectors. It really was a market within a market. And this chart just lays it all out, clear as day. On one side, you had the government banks, the PSU banks, which had an amazing year, shooting up by 30%. But then you look at the IT sector, which has been everyone's favorite for years, and it got hammered, dropping 20%. It's like one half of the ship was rising with the tide while the other half was taking on water. So here's the number that really matters, a 50% gap. Just let that sink in for a second. In the very same market, you could have been up 30% or down 20%. That's the difference between a great year and a terrible one. It just goes to show you, it wasn't enough to just be in the market. You had to be in the right part of the market. And this brings us to a huge classic trap for investors. It's so tempting, right? You see silver up 130% and you think, I got to get me some of that. But investing based on what just happened is a terrible idea. It almost never works. It's the surest way to buy things after they've already gotten expensive.
So if we're not supposed to look in the rearview mirror, where do we look? Well, we look forward, through the windshield. And the best tool we have for spotting the real opportunities ahead is a little something called valuation.
So what is this secret weapon? Valuation. Think of it this way. Price is what you pay, but value is what you actually get. Valuation helps us figure out if we're getting a good deal. Is this asset on sale, or is it overpriced? By comparing where things are priced today to their own history, we can find those hidden gems that everyone else is ignoring. All right, let's start hunting. First up, the banking sector. We use a metric here called price to book, which basically asks, how much are we paying for the bank's actual assets? And right now, that number is at a 5-year low. If you take out the crazy once-in-a-lifetime COVID crash, banks have not been this cheap in half a decade. To a value investor, that's a huge green flag. Okay, now let's talk about last year's loser, the IT sector. After that 20% drop, something really interesting happened. Its valuation, which we measure with the price-to-earnings ratio, has come way down. It went from being really expensive at around 30 times its earnings to a much more normal 22 times. It's basically back to what we'd call fair value. It's not a screaming bargain, but it's no longer overpriced, which means it's definitely back on the radar.
And here's another one that the market seems to have completely forgotten about, FMCG, or fast-moving consumer goods. The companies that make all the stuff we buy every day. Right now, this entire sector is trading at a 10-year low valuation. Let me say that again, a 10-year low. Besides that brief COVID panic, these stocks haven't been this cheap in a decade. You know the old saying, be greedy when others are fearful? Well, this is a sector a lot of people are fearful of right now.
Okay, let's shift gears for a minute. I want to talk about a really powerful strategy that smart, wealthy investors use all the time. It's about how to get cash when you need it without messing up your entire long-term investment plan. So, this is what most of us do, right? You need cash, you sell some stocks. But this has two major drawbacks. One, you have to pay taxes on your profits right away. And two, and this is the big one, you are permanently out of the game for those shares. If that stock you sold suddenly doubles, well, too bad, you missed it. Now, here's the smarter way. Instead of selling your assets, you can borrow against them, just like you would with a house. You use your portfolio as collateral to get a line of credit. This gives you the cash you need, but, and this is key, your investments stay invested. They keep working for you, growing over time. You don't trigger any taxes, and you don't miss out on any future gains. It's a total game changer. All right, we've covered a ton of ground here, from what happened last year to where the opportunities are now, and even some advanced strategies. So let's pull this all together into a simple, actionable checklist to guide you through this new financial year. Here it is, your 5 golden rules for FY2027. Number 1, focus on value, not last year's hype. Number 2, diversify. Don't have all your eggs in one basket. Number 3, go bargain hunting. Look for those quality sectors that have been unfairly beaten down. Number 4, always keep some cash on the side. You want to be ready when the market gives you a sale. And number 5, think like a pro. Consider borrowing for cash needs before you even think about selling your winners. And that really brings us to the final question you need to ask yourself. Right now, the market is basically having a sale on some really high-quality sectors. While everyone else is panicking or chasing yesterday's news, are you prepared to be the smart one? Are you prepared to look at the value and be a buyer when others are selling? Because that, right there, is how real wealth is built.
Learn to invest smarter. Follow for market analysis, valuation insights, and wealth-building strategies for FY2027 and beyond.